Hello, ladies and gentlemen. My name is Lars Schall. On behalf of Matterhorn Asset Management, I welcome you to a special interview series with the geopolitical analyst, economic researcher, and book author F. William Engdahl. Mr. Engdahl. For the first question, I would like to ask you, is it much too short-sighted to view the financial crisis just as a result of a popping bubble in the US?
It's not only short-sighted. The subprime crisis in spring of 2007 that first erupted into public view was only the trigger of a much deeper crisis. And what you have to do is take a retrospective going back and look at the successive events in the U.S. financial world, Wall Street and Washington and so forth. The deregulation of derivatives, off-balance sheet instruments were allowed, and then in 1999, Larry Summers and a young assistant of his at the Treasury at that point drafted what became the basis for eliminating Glass-Steagall, the separation of investment banking from commercial banking, and an insurance company, Travelers, Sandy Weill, bought up Citibank, and that began the creation of institutions that were, well, they said too big to fail. I would say they're too big to save. Where the balance sheet of the largest 6 banks in the United States suddenly exceeded $1 trillion or more. Bank of America, JP Morgan Chase, and so forth. And that gave Wall Street, to use a term from Hollywood, a license to kill, literally. And they created the subprime crisis with help of the Federal Reserve Chairman Alan Greenspan at the time, after the dot-com bubble popped in the early 2002. And Greenspan was quite explicit that he was going to create an incentive for people to buy homes, real estate. And he supported a system that he knew quite well, even though he didn't say it publicly. But if you carefully analyze his speeches to Congress and his public pronouncements, he thought this new financial revolution with credit default swaps and the securitization of home mortgages was the most brilliant genial invention since the creation of money. And of course, and I tend on this question to agree with his predecessor, Paul Volcker, who said, after the crisis broke, I can only think of one financial innovation in the last 30 years that I would call a positive contribution to the economy, and that's the automatic teller machine. All of the other, the securitization of mortgages and other instruments, the credit default swaps where you can take out insurance on your neighbor's home, which has dubious moral implications, of course. All of these things were a way to allow the Wall Street banks to convert the world economy into a huge casino. And the music stopped in 2007. Everybody scrambled to look at their balance sheet, all the big banks around the world, to see how much toxic waste they actually had bought, thinking it was not toxic. The rating agencies were up to their necks in this business because they made a huge amount of their annual income from the rating of the bundled home mortgages into bonds that were backed by nothing but a AAA rating and some insurance from tiny specialized niche insurance companies in Wall Street.
Yeah. Would you say that the financial crisis, now that it is there, is tackled at all in a proper way, for example, related to the shadow banking system?
Nothing fundamental has been done anywhere in the world, other than in Iceland perhaps, that tackles the fundamental cause of the system. Once the crisis broke, then we have to understand that modern banking, since the time of the Bank of Amsterdam in the late 1600s, has been based on fractional reserve creation of money by banks, and once that means that the assets at home in the bank are a fraction of what's lent out. So you have this entire pyramiding or leveraging of debt by the international banking system, and shadow banking, any other kind you can imagine. In China, they use copper because China was the biggest world consumer of copper the last 10 years. So they were doing shadow banking transactions with copper warehouse stocks in China as a collateral. Now the government has just come in and issued a rule against that. So you're going to probably have an implosion of a whole debt pyramid internationally related to this cutting off of this copper possibility in China. So you have an entire structure that's based on confidence. Modern banking is based on confidence. And you can take that any number of ways. You can say it's a giant confidence game, or con game, which is the American slang for the term. It's a Ponzi scheme. That's an accurate term as well, if you understand the history of Ponzi in the 1920s, during the Wall Street Roaring Twenties stock bubble. But once you have a crack in that process, the whole structure comes into doubt. And now it began in Europe with Greece, back in 2009, 2010. That quickly spread to the next weak link, which is Portugal. Then it became Portugal and Italy, the so-called PIGS, P-I-G-S, Portugal, Italy, Spain, and Greece. And then Ireland was added to that. So very soon, most likely Holland will be added to that. The situation in Holland is horrendous, but the banks, up until very recently, were allowed to carry worthless, non-performing home mortgage debt on their books as full market price. Now that's changing because of government rule changes in the last 6 months. So Holland is a candidate for a future crisis. France is certainly a candidate, and were that to happen, the entire euro structure would come into doubt. So once you begin something which is based on so little hard equity, hard collateral, then you're going to have a race to be the first out the door, and that's what we're witnessing. The central banks have stepped in to make that race out the door more orderly, but more than that, they're not doing.
Has the so-called Asia pivot of Washington something to do with the geopolitics of finance?
Well, I think it's a more fundamental reason driving Obama's decision to make a so-called Asia pivot, which he announced a year and a half, 2 years ago during a speech in Australia. And that is to refocus the Pentagon and the American military presence from the Middle East to the South China Sea, to Australia, to India and the countries surrounding China. It's really the China pivot, and he's being euphemistic by calling it Asia pivot, but the danger is not terrorism in Asia. The danger is the giant elephant in the room called China. And China has increasingly, and I've been to China, I've spoken at most major universities and met with government officials and intellectuals of every variety in China over the last 5-6 years, and they are increasingly speaking their own mind as a sovereign nation, and the fact that they're rapidly becoming the largest economy in terms of GDP in the world. Some say it could surpass the GDP of the US by 2015. Regardless, they have become a giant factor in the world economy, and if China gets sick, now the rest of the world starts sneezing. So the Obama pivot is designed to make sure that growing China, that emerging China, is going to play by a rule book written in Washington and not in Beijing, put as simply as you can put it. And the Chinese are very proud people, and they don't necessarily like people writing their own rule books for their national economy for them.
Yeah. What is your reading of the topic of the TransPacific Partnership?
Well, you can see that or view that in the context, I suppose, of the Asia pivot. Increasingly, people in Washington and certainly people in Wall Street are becoming concerned that China is becoming more and more independent, that China-Russia cooperation on issues such as drawing the line in Syria against regime change, things like that. And the Trans-Pacific Partnership is an attempt by Washington to seduce China's major trading partners in Asia into a U.S.-Asian partnership minus China. China is conspicuously absent in the TPP. Recent events indicate that the Trans-Pacific Partnership is virtually a dead letter. The Asian countries have so much mutual trade involvement with China that they're not about to sacrifice that for trade with an American economy that's realistically seen as in a major depression, not a recession, not a recovery certainly, but a Great Depression.
In more and more countries, when they do trading with China, bond the dollar. This is a huge challenge for the dollar?
I think over time it will be, as the renminbi becomes fully convertible over the next few years. To become a world reserve currency is something that takes time. The euro was beginning to emerge as an alternative to the dollar in international trade and central bank reserves, and then quite conveniently for the dollar, the euro crisis erupted with Greece back in 2009-10. But that will take time. But what is happening is that the use of dollars to mediate trade balances between China, South Korea, China, Japan, China, Russia, and so is being replaced on a bilateral basis with their own currencies. And that over time can have serious implications for the dollar. Although the ironclad rule that's been enforced since the 1970s oil crises, that OPEC only sells its dollars on the world market for its oil on the world market for dollars, that still holds. I don't see any immediate signs that Saudi Arabia is about to revolt against Washington, as long as they're getting $10 billion defense equipment deliveries from the U.S. military industry and the U.S. government.
A lot of people talk about hyperinflation or the prospect of hyperinflation in the U.S. Is one possible scenario that the world increasingly abandons the dollar, and so the surplus dollars that are floating around outside of the U.S. come back inside the U.S.?
Well, I think there are many possible scenarios, but the hyperinflation, you've had this money creation without limit by the Federal Reserve. The Fed is buying more than $80 billion of U.S. government debt per month because the Chinese are reluctant to take on more of this paper money as an investment for their trade surpluses. The trade surpluses are also declining with China. But other countries are becoming increasingly hesitant to increase their dollar exposure. So the Federal Reserve is pumping money into these banks, but like Keynes said during the Great Depression, it's like pushing on a string. They don't get any traction because the banks, given all of the requirements that they make more conservative portfolios for their lending, and the fact that they have so much toxic debt still on their books that they're trying to work down, deleverage, the banks aren't lending it into the real economy, so it doesn't have the inflationary effect that it could. The lending is going direct to the stock market to create bubbles in the stock market. So that's where it goes, or it goes to Japan for the yen carry trade, now that the Bank of Japan is flooding the world with yen and such things. But that's not traditional hyperinflation like you had in Weimar in the 1920s.
But would you say that the American stock market and also the global bond market are nearing a bubble?
They are a bubble. They're not nearing, they're in it.
And are they the mother of all bubbles?
Well, the bond market, because the bond market is the mother of all financial markets, and if that begins to explode, you're going to have quite a, stocks can come and go, but state debt is really the heart of the system.
Yeah, and will this end in a catastrophe?
Well, that's a very difficult question. At the time of the 2007 outbreak of the so-called subprime crisis, which it was much bigger than, I publicly advocated in speeches and seminars to various investor groups and so forth, and in my writings, I publicly advocated that the only workable policy was something like what the Swedish government did in 1992 when they had a banking crisis caused by uncontrolled real estate speculation. I mean, they were building real estate construction projects in the air by buying the air rights over the Stockholm Central train station and putting up skyscrapers there with it was just complete abandon. The banks didn't have any experience in real estate valuations. They just created a bubble. The bubble collapsed, and in 1992 what the state did was nationalize those banks. Not a dirty word, not a socialist word as Henry Paulson claimed it was at the time when some people suggested this. But what they did was they took what's now called Nordea Bank, one of the most well-run banks in Europe today, interestingly. They took several of those banks and nationalized them. They fired the management that had caused the uncontrolled speculation and taken the unhealthy risks, and they began cleaning the balance sheet. They created something called Securum, or the good bank, bad bank model, and they took all the dodgy mortgage debt for buildings that weren't completed or the overbuilt markets and so forth, and kept those off of the real estate market for a period of 3 to 5 years. And otherwise, the banks could function under state control and supervision. The banks could function as normal lending banks for commercial and retail banking. Then, in 3 to 5 years, the Swedish economy began to recover, and so those real estate assets could be sold off onto the market in a slow, controlled way that didn't collapse real estate prices further. And in the end of the day, it was calculated about 10 years later that the net cost to Swedish taxpayers of the nationalization, the Securum strategy, was a net profit. That the sale of these real estate assets in a rising market actually gave the state account a small net profit. So it cost the taxpayer in end effect at the end of the day nothing. That should have been done had the U.S. Treasury and the U.S. government not been essentially under the financial control of Wall Street and the Federal Reserve the same. That could have been done in the U.S. financial crisis in 2007, and a huge amount of damage to the real economy avoided. A huge amount of damage to the world economy avoided. They didn't do that. Wall Street instead used their enormous lobbying pressure. They financed presidential campaigns. Every key appointment that Obama made in the financial realm was either Wall Street friendly, connected with Goldman Sachs or Citigroup. Every single one. And you can go down the list one by one. I've done it. So the power of these banks had become such that their balance sheet was larger than the gross domestic product of most nations in the world. That's a power that should not be allowed in a healthy world economy. That's simply too much political power in too few hands. So they literally dictate to Washington what Wall Street wants, not the other way around.
Okay, thank you very much for the first part. Ladies and gentlemen, this was the first part of a 3-part series of interviews that I conduct with Mr. F. William Engdahl. Goodbye.